Did you know the Philippines' external debt reached an impressive $128.7 billion as of March 2024? This might sound alarming, but what does it really mean for the country, especially in comparison to its ASEAN neighbors? And why should foreign investors care? Let's dive into the details. In the first quarter of 2024, the Philippines saw a $3.3 billion increase in its external debt from the previous quarter. This brought the total to $128.7 billion. However, what's crucial here is the external debt-to-GDP ratio, which sits at 29%. This figure is particularly important because it measures the country's debt relative to the size of its economy. Despite the rising debt, this ratio indicates that the Philippines is managing its debt load effectively. The key reason? Most of this debt is long-term, meaning the country has more time to repay it without putting immediate pressure on its finances. But what makes this story even more interesting is the Philippines' position within ASEAN. Among its neighbors, the Philippines has the lowest external debt-to-GDP ratio. For comparison, Malaysia's ratio is at 69.3%, Thailand's at 39%, and Vietnam's at 38.6%. This conservative approach to borrowing reflects a strategic effort to mitigate foreign exchange risks and ensure economic stability. It's a significant point for foreign investors looking for stability and growth potential in emerging markets. Here's a fun fact. Despite the Philippines having the third largest debt growth in ASEAN during the pandemic, it still managed to maintain the lowest debt-to-GDP ratio. This resilience showcases the country's prudent financial management, which has become a cornerstone of its economic policy. Let's talk about why this matters to you, especially if you're considering investing in the region. The Philippines' ability to manage its debt efficiently, even as it grows, makes it a safer bet for investors. The country is not over-leveraging itself, which means there's less risk of a financial crisis due to excessive debt. Furthermore, the fact that much of this debt is long-term gives the government flexibility in managing repayments, allowing more resources to be directed toward growth initiatives. Comparing this to other ASEAN countries, Malaysia's higher debt ratio could indicate more immediate financial pressure, while the Philippines' lower ratio shows a more balanced approach. For foreign investors, this balance between growth and financial prudence makes the Philippines an attractive destination for investment. It's a sign of a stable economy that is growing, but not recklessly. So, is the Philippines in financial trouble? Far from it. The country's low debt-to-GDP ratio, combined with its strategic long-term borrowing, indicates a well-managed debt profile. This positions the Philippines favorably compared to its ASEAN peers, ensuring not just economic stability, but also a strong foundation for future growth. For investors, this means the Philippines offers a compelling mix of stability and growth potential. The country's conservative financial management, particularly in its external debt, reduces risks and provides a solid platform for investment. Whether you're looking at short-term opportunities or long-term growth, the Philippines is a market worth considering. Thank you for tuning in. If you found this valuable, please show your appreciation by giving a thumbs up and subscribing to OHA News Asia, your trusted source for knowledge always at your fingertips.